I was watching over the weekend a Netflix series about Conor McGregor, the UFC fighter. But what I could grasp from the series was Mr. McGregor's focus, his ability to focus. It's about focusing and understanding what your strengths and weaknesses are.
Is that a lot of those successful people, success can be defined in a lot of different ways, have focused on very specific things, right? Athletes are a really easy one. I could think of right off the top of my head, you have Kobe Bryant, you have LeBron James. You want to go business, you're looking at Warren Buffett, Charlie Munger, Bill Gates, Elon Musk.
Dr. Dre.
Dr. Dre also very relentlessly focused on a very certain thing, and they've maximized that. And they do not get distracted by outside forces.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my colleague, Nathaniel Leach. And today our topic is 4 trendy industries that Nathaniel will not invest and what some of his exceptions are to those rules. So before I start asking Nathaniel some of these questions, we just want to state that this is not investment advice. This is all has to be based off of your income, spending patterns, retirement goals, investment skill sets, and so forth. So this may not apply to you, but it is some really good general information to get a little bit deeper into what Nathaniel will invest in, what he won't invest in, and why. So before we go to Nathaniel, the 4 topics we want to hit are commodities. So think like oil, gas, gold, silver. We also want to hit on cryptocurrency, specifically Bitcoin. We also want to then touch on real estate. And lastly, we want to hit on heavy cash or would be considered cyclical industries, which we'll get into at that point. So Nathaniel, to start us off, you tell people all the time, they come to us, I want to invest in gold. I want to invest in silver. I want to invest in oil. And you typically tell them no. But you do have some exceptions to this specific industry. So tell us about why you won't, and then what you will invest in.
Sure. So the issues that I typically have with anything in the commodity world is that it's typically this is actually going to fall into our 4th topic, but it's still slightly different. It's a lot of cash up front, a lot of investment up front. It's typically very CapEx heavy.
Wait, got to pause you for the audience. CapEx. Don't go any further. Please explain what CapEx means.
My apologies. Capital expenditures, CapEx.
So give us an example. What would be a capital expenditure?
So having to buy the mining equipment required to mine the gold, for example, out of the ground, or to purchase the parts required to build an oil rig would count as CapEx.
And it's safe to say that companies would have to take their earned cash, use that earned cash, then to invest back in to make sure that their business model is sustainable over time, right? Typically.
Or debt.
Okay.
Capital encompasses everything produced from the business, as well as any debt that you can procure from the business or on behalf of the business to invest in the CapEx.
Okay, bring you back. So you're talking about you don't like companies, specifically this industry, because it is heavy CapEx.
So CapEx is one big part of it. Yes, the heavy spending up front to get the revenues out of the ground, for example. But the other big part of it is that commodities are tied to the market prices of the underlying commodity. So if my cost to dig gold out of the ground is $100 per ounce, let's say, and gold is trading at $200 per ounce, which is not, just look it up anytime, your profit or your gross margin, I should say, is $100 per ounce. So it's $200 for the market price minus the cost of digging that gold out, $100. You're left with $100. And then from that $100 per ounce, you then have to pay your people to dig the gold out of the ground. You have to pay all these other expenses. And then what you're left with is your underlying profit, which in some cases can be very small relative to the large market value that the commodity is selling for. That is investing in commodities. But so that's why I don't typically like those kinds of, for example, miners of gold, silver, any type of commodity, or companies that invest in drilling oil or gas out of the ground. But that's not to say that we don't find ways that we can't think of ways to invest in it that we would feel comfortable with. There are, and that's principally within royalties. So this would require an investment on your part, but you're not having to pay for the equipment to get the gold out of the ground or the oil or gas out of the ground. You're simply putting upfront investment that you then receive in return a royalty, which can be structured in many different ways, of the underlying commodity that is being pulled out of the ground or out of the sea, if what have you, like an oil rig or something.
So if it's safe to say, to kind of summarize a little bit of what you just mentioned, is I'm going to go back to your example of $200 an ounce is what the price of gold is. It costs me $100 an ounce to extract, right?
Mm-hmm.
So I have this gap, right? Mm-hmm. So I'm making, or not making, but can use to then extract, obviously, whatever mineral I'm taking out. And I'm assuming that because this price, there is no control for that, right? Like the control factor of how much it costs, it could drop down to 110 an ounce, and it's still going to, potentially cost you $100 an ounce, which means you can get into a very sticky situation.
That's actually a really great point that you brought up there, Tim. And I just want to quickly hit upon that, is that you are subject to the market risk, which is a huge risk because you can't set up a gold mine overnight. It takes years to set up a gold mine. So it's a matter of supply and demand. So if there's too many mines operating, what's going to happen to the price of gold? It's going to go down.
Yep. And so then when you're looking at royalties, what you're saying is there's a little bit more control maybe on the financials to understand that business model, because yes, you're still affected by the price of said asset, either gold, oil. But if you have royalty towards it, you are also not expending that $100 an ounce to extract it, because that's not what you're doing. You've just owned the rights to it.
Correct. You typically receive a portion of the revenues, the gross revenues, a percentage of that.
And would be safe to say, specifically in this industry too, that in order to be good at, let's say, mining or extracting, you have to really understand that specific industry, have really deep knowledge. I'm assuming regulatory, market risk, like all of that is probably deep knowledge. And you probably would have to have more of a scale game, economies of scale to a certain degree, in order to probably make it a feasible, maybe, business model.
Yes, definitely from the perspective of if you're actually the miner, the company that is mining that. But from an investor's point of view, I don't think you need to have a basic understanding of the industry itself. But if you're going to play the royalty game, what you want is actually a diversity of bets. So you want to have a scale game in terms of the number of bets that you've placed with individual producers, perhaps in differing geographies of a particular niche, and having an understanding of that niche and then applying it accordingly across multiple bets.
Got it. Okay. So there are places that could make sense from an overall business perspective, but it just depends on how you're starting to view the industry at large, right? You could look at, commodities, and then it breaks down into a fraction of different things that you want to play in or not play in. And some people are playing in the commodities markets because they are actually owners of this physical product. So they need to hedge their own business by buying futures contracts, things like that.
That's a whole other,
which is a whole different ball of wax. Yeah. Okay, very cool. Do you have anything else you want to hit on when it comes to commodities and things like oil and gold or gas?
The great thing about royalties is that it's an asset-light business. So you're not investing in equipment necessarily. You're investing in companies that are mining the commodity, so to speak. And then you spread that across multiple bets. It's a decent business model.
And just to tie that in, asset light kind of falls back into your idea of capital expenditures.
Correct. Sorry. So it's an asset light investment in that you're only putting up money, and you're not required to own a number of large assets like mining equipment, for example, and then perhaps having to take on leveraged debt to acquire said mining equipment. And it releases you from a lot of potential risks.
Got it. Limit the risk, hopefully good return over time. All right, very cool. So that's commodities specifically. Now, topic number 2, we want to talk about cryptocurrency, but I think we're going to guide, again, thinking of commodities and the fractions. I think cryptocurrency is a very broad topic. We're going to slice that down for us to make it a little bit easier. We're going to talk about Bitcoin. So people come to us, they've done this for many years now, that Bitcoin specifically has been very attractive from a price perspective, but it acts very similar to gold, kind of in that same realm. It's a very different kind of mining, but why would you not invest in Bitcoin? But then also, why would you invest in other types of technology behind how Bitcoin is created?
So we would not directly invest in Bitcoin. That's not to say that some of the funds that we invest in have some investments related to Bitcoin or other cryptocurrencies, which they do. But we don't feel comfortable with it ourselves because of exactly what Tim pointed to, which is that the market price of it is not really tied to an underlying factor. It's almost speculative in nature. There's arguments that the market price is tied to the supply of Bitcoins, and then because it has a limited supply at some point in the future, and then the demand of Bitcoin. But there's other issues at play there that we've never felt quite comfortable with. And so we just don't feel comfortable investing in it. But one of the advantages that we have, that we believe of Bitcoin, is the underlying blockchain technology, in that when it comes to example, for when you buy a house, there are a number of different parties within that transaction that are each taking a little piece. So you may wonder, why does the realtor get 3% of whatever the price is, and then there's 2 realtors to each transaction? So 6% of the sales price typically goes to the realtors. But it's not just the realtors who are getting money. There's also other parties tied to the realtors, the title insurance companies, all of these other parties that are a part of that transaction. Those come at a cost. Blockchain technology, it's already happening in practice, very small, but perhaps over time, it could lead to where that transaction becomes much more seamless. Where if it's at some point in the future, if I were to sell my home, and that home was to somehow be placed on a blockchain of some sort, and then I wanted to sell my home to another party, then it could be done like that. But as we know from experience, when it comes to the selling of a home today, it typically takes anywhere from 30 to 45, even longer, 30 to 45 days. So in theory, the blockchain could really crunch down that time period, and it could come at a lower cost. That's extremely exciting. And that's just one example. That can be applied to any other type of real estate transaction, any type, maybe perhaps business transactions, or even the settling of stock trades, for example, or bond trades. That's very exciting. So we always keep a lookout for those kinds of companies. There's definitely companies already out there playing around with this sort of thing, but we're of the mind very similar to when there was a gold rush here in the United States. Generally speaking, the people that made money were the people that invested in industries that were gold adjacent. Levi's, miners, that supplied the picks and shovels, so to speak. We're of the same mentality when it comes to that sort of thing. And then there's also like cryptocurrency adjacent businesses, such as the mining of Bitcoin, for example. Companies like those, if they can do that in a energy efficient manner, there's a lot of cost to the mining of Bitcoin. If that can be done efficiently, then there's also some interesting things that can be done there as well.
And I think you make a really strong point too when it comes to Bitcoin and the underlying technology, blockchain technology, where you could, so the settling stock trades. Mm-hmm. Do we think that a new company is going to come out and unravel Schwab? Right? Probably not, but that doesn't mean Schwab may not use blockchain technology to improve their own business, right?
Exactly.
This technology is not just isolated to a certain company. If companies that are larger could utilize this technology to better themselves, that could be a real thing. I will say what is also interesting specifically about this type of technology is some of the problems that you have to solve are not going to be solved by computers. You have to get organizations and people okay with how this actually functions and works.
Yep.
Nathaniel just mentioned real estate. Well, you could potentially displacing some jobs, lowering income right there.
Mhm.
That is transformative. It is a paradigm shift to a certain degree.
Mhm.
So it is that one specifically is fun to think about. But as Nathaniel mentioned, we're always looking kind of on the outskirts of where that may sit, where that may be, how this is going to be affected. And it may be in companies that Nathaniel already owns, right? They could be using it to kind of benefit their own organization with what's going on specifically. So, okay, Nathaniel, now we're on to number 3. Number 3 is an interesting one. I personally get this question quite a bit on my side of the job, right? People are always asking us, hey, what can I invest in? This topic comes up probably daily. And that is real estate, right? Real estate is tangible, physical. The one thing that I hear all the time is you cannot make more land. So if you only have so much land, right, you can only build. So real estate will always appreciate. It's always been the American dream, owning a home. There's a lot that kind of is tied behind it. I want to know why you would invest in real estate, why you wouldn't invest in real estate, and maybe how you would go about that specifically.
I think I would counter with it. It's a matter of how you invest in real estate and how you actually execute on it. We generally don't think it's a good idea for most people to make an investment in real estate by themselves, because we have found that people consistently underestimate how much time of theirs is taken away to actually run an investment real estate business. Like, for example, just buying an extra house and then renting it out to somebody. That actually can turn into a part-time job, anywhere at least 20 hours a week, that you might have to do the balancing of the books on the back end. You have to make sure that you have insurance that covers you in the event of something happening in that house. You have to make sure that that you can properly rent it out to somebody, that you have to have taxes or licenses with the local municipality, right?
And Airbnb is very specific. A lot of counties and stuff come in and put pretty strong regulations on short-term rentals in certain areas as well.
And then also the being on call. You have to be on call unless you farm that out to a property management company, for which they're going to take an immediate percentage right off of the top in order to manage that property for you. And even then, the experience that they provide on your behalf to manage that property might be substandard to what you would want to provide to that end renter. That might potentially be bad for your business in the long run. People don't recognize. Dan talks about this all the time. He rented out his first home. He had moved elsewhere and he rented it out for a period of time. And he told me the story about how I think the heater broke or the furnace broke in the basement. I can't remember which.
Okay.
And he told me the story about how he had to lug the new one down the stairs himself and install it. He didn't want to be spending his time doing that, but it was a cheaper way to go. But he actually expended a great deal of his time to make sure it was that he had to get it down the stairs, install it correctly, make sure it was working, because then you could have been dealing with all sorts of liability stuff if it had been installed incorrectly. But he had to do it because he didn't have any other option at the time. He didn't have any property management company to do that sort of thing.
Yeah. I think I would add on to that as well, as Nathaniel just mentioned, that there's potentially a lot of time, additional cost. I think also what you're trying to build, right? Is it really a replacement of income over the long run? Are you looking at appreciative assets? And then how do you enter into the market as well as a whole nother ball of wax in itself? What I would say too that sometimes is missed, and I'll use primary residences as a good example. People in the last probably 5 to 10 years have made some really good money on their primary homes just based on where the market is, especially in the last 2 to 3 years, due to most of the United States kind of accelerating in price. That was kind of a COVID effect in a way, especially low interest rates. And so, but what happens though is people say, well, I bought it for X and I sold it for Y, right? But then they forget about all the good stuff in the middle.
Yep.
Like
Their mortgage payments,
mortgage payments, interest payments, right?
property taxes,
Property taxes. Are you looking at any updates, renovations?
any maintenance of any sort, having to replace things.
And then what was your true return,
Mhm.
right? What was actually happening? And I think sometimes when people get into their own rental real estate, they don't take the time to really actually detail out, well, how much money did I really make?
Mm.
What was my actual IRR or cash on cash return relative to putting in the stock market, relative to doing something else? And that's just looking at the numbers. I think people don't take the time. We encourage people to do it, to actually see what's going to happen. And also what happens is you really want to have a longer term time frame when it comes to any investment. And I think sometimes people will miss on that specifically, but it's not just, hey, I bought my rental for X and I sold it for Y, because you redid the deck, you did the furnish, you paid the property management company, you paid taxes. It's like those capital expenditures Nathaniel was talking about earlier. What is your true return on that specifically, which is why we like to invest how in real estate.
So we typically prefer to invest in truly passive real estate investments, which is typically via the means of something that's called a real estate investment group. So these are professional outfits that do all of the work for you, and then typically they have some form of a quarterly distribution to you. Not always guaranteed, but that's typically what happens in these kinds of groups. And you receive some income, and then at the end of the period of time, could be, it depends on the fund, but the fund investment, but you could have your money back in as little as 3 years, but then sometimes they could go out to 10, 12 years. You don't know. The trade-off is that you're giving up control of an asset and liquidity in return for investing with professionals that have a long history, track record of doing this kind of thing. So that's typically our preferred method. And then if I could just add on to what you mentioned, Tim, about the quantitative aspects of owning a home. I touched on it briefly, but what I would really like to hit on is the qualitative, which is your time. Everything that we do, we are constantly asking ourselves, how much is our time worth relative to what we are doing? That's what it doesn't stop you from doing that on the personal side as well. And then even so, if this investment real estate is a business, you should then be asking yourself, how much is my time worth relative to how much time I'm putting into this?
Yeah, relative to other potential investment opportunities.
Exactly.
It's always a relative game. And I think that is something that is difficult. There is plenty of ways to make money. It just depends on what route do you want to take and how do you want to go and execute on that strategy.
And what works best for your circumstances.
Correct. 100%. I like that. So real estate, that's a big one. We always talk about it. We like to talk about it. I do agree with Nathaniel when it comes to the real estate investment groups in different ways. I think that there is a stream of conscious throughout this where this is very nuanced. If you talk to people who do run this professionally, they're always like, good luck to kind of start it up, right? This takes years. This takes time. It takes, coordination. There's a lot that goes in, and they do sometimes have power because they've vertically integrated certain things such as construction, maintenance, in-house property management, as to Nathaniel's point, so that they make sure that they are appropriately servicing those that they own, right? So it is definitely a lot more to it. And we always like to try to educate people. If they want to step in, we're very supportive of it, but we're really trying to make sure that they set their expectations appropriately. It's really what we try to do. All right, our last one, Nathaniel. This one might have to do a little bit of explaining here, just so people understand what you're saying. So you really don't like cash heavy and cyclical industries. So some of those would be like shipping or utility companies, or maybe railroads, but maybe not railroads. Depends on how you want to look at that. But overall, you're not a big fan of those. Why? But also, like railroads, why would you invest in some of these things?
So typically, I don't like these kind of industries because so it's two main points. It's cash heavy, and that means that upfront investment required in the beginning, and then also the cyclicality of the industry. So shipping is a great example of cyclicality. So we saw this with COVID, where there was this huge backlog of supply that needed to get from point A to point B. And there's a whole other number of issues due to COVID. But what happened was that the shippers minted money. because they could charge whatever rates they wanted. Well, I mean, not in practice really, but they really push the boundaries of what the market could afford to pay. And then they proceeded to do so, and they made a lot of money. But those kind of industries, they're very cyclical. So like the pandemic is an extreme example, but during, for example, the Great Recession, you also saw this as well, where there was a time lag on the supply of the shipping, but then there was like this after lag of where the shippers made a lot of money during that period. But then it ebbs and it flows, and over time it normalizes, but it's just not a very consistent recurring revenue business, which I'm just not. You can't really have a lot of debt in those kinds of companies, because then you're just subject to you're at the whims of the debt. But over time, the shipping industry has consolidated into a smaller number of shipping companies. So they have scale that can help them minimize these waves over time. They can be good investments. They're just not, you just have to be really quick moving to take advantage of those kinds of things. And then you're at the whims of the market. So that's where I just don't feel comfortable with that. But then there are other industries that kind of follow these similar trends, these similar characteristics, if you will. For example, utilities, so such as like electric utilities or railroads. Those are different animals, though, because while they can be very cash heavy and upfront, they're not necessarily cyclical, but they also have scale. So, and then even in the case of both electric utilities and railroads, they have regulation, which can be both beneficial and not beneficial.
Detrimental,
to a certain degree. But for example, in the US, the railroads have greatly consolidated over the last few decades. So they have pricing power to an extent, but they're regulated. And then when it comes to like, you can't replicate, it's very difficult to replicate a railroad today. It's very difficult to compete against other railroads. It's very difficult for me to say, I'm going to start up a railroad. You know how many billions of dollars that would cost to do that? It's ridiculous. So those kinds of businesses have a moat in that they have some pricing power. They have power because they're regulated. So it's very difficult for competitors to get in and successfully attack their businesses. The same concept goes for electric utilities, where the utilities supply electricity to your home or place of business. The sources of how they provide that's a whole other different story, coal, natural gas, etc. But because they're regulated, they're legally able to say to the federal the FEC, they're able to say, listen, I want this return on equity for our shareholders. And the FEC signs off on that, which could be like 10 or 12% of return on equity. So that allows these companies to heavily leverage up on debt to then be able to return capital in the form of high and increasing dividends to their shareholders. So off the face of that sounds like a great deal. Oh, I get some income. That's awesome. But then you have to think about, are our electric utilities, the majority of them, have they been invested in? Or have they been taking funds that they're legally able to charge to their customers and then distribute those to their shareholders, but they're not reinvesting within their electric grid, the grid that helps distribute the electricity to the end consumer? I would argue in the US, that's probably not the case the majority of the time. There are exceptions to that, but the majority is not so much. So there's always exceptions to every one of these, but for us, examples would be like the railroads or electric utilities. There might be some opportunities there. It's just not black and white, cut and dry.
Gotcha. And a lot of it too is you are always looking, I kind of think about it like this. You kind of want to be Scrooge McDuck, where you have all your gold coins and they continue to accumulate, and you don't want to take your gold coins and invest into more utility or more things for the business, right? It's like it's super cash heavy, which means I have to, as Scrooge McDuck, give up my gold coins to reinvest in it. You're like, nope, I want to keep my gold coins as much as possible. That's why you like royalties. That's why you like certain other things specific around that, where it's a little bit more well known and you can kind of predict it out into the future, for example.
Sure.
Okay. Well, that's really good. So we got the 4 topics. Do you have any last thoughts? Do you want me to go first?
Yeah.
All right. I think overall, I like all these topics. And I think what Nathaniel really highlighted, in my opinion, is that we are never for anything and we're never against anything. We are just against how people execute or the expectations in which people set. Our job is to make sure people understand what they're getting themselves into.
Mhm.
And as you could tell through all of Nathaniel's bullet points here, there's nuance to every industry. There's nuance to every investment. And what we try to do is make sure that we try to understand it as best we can. And we recognize that we can't understand everything. That's impossible. There's a ton of companies out there. There's a ton of real estate companies. There's a ton of blockchain companies. It's impossible to know everything. So you want to make sure you just stick into what you know well. So typically speaking, when we have clients come to us and let's say they own their own business, we always ask, why are you trying to invest outside of your business? Right? Maybe you want to reinvest in it because it's a better rate of return. You understand it, you know what's going on. Sometimes we need to come in and help a little bit on the financial side to get some acumen picked up a little bit. But outside of that, it could be very beneficial because you truly understand how the industry works. And those nuances at the end of the day, as Nathaniel has mentioned, contain risk. And that risk is what you're trying to mitigate. Specifically, when you're looking at some of the topics such as cash-heavy businesses, such as commodities, right? Commodities is a very nuanced industry. We have some clients that are involved in that type of industry. And I am wowed every time I talk to them about it, because it's like, wait, what goes into this? How much? There is a lot of moving parts. And if you're not aware of those moving parts, that's where you can start making potential mistakes. So I really like that we can go through, and again, we're never forcibly, and we're also never against it. It just depends on how you execute. That's what I got.
So I actually want to go off on a different tack to round this up, if I may. I was watching over the weekend a Netflix series about Conor McGregor, the UFC fighter.
Ooh, I have not seen that.
It's actually, I don't necessarily approve of some of his tactics, like in his loud, brash persona outside of the ring, the psychological warfare. I just don't. But that's besides the point. But what I could grasp from the series was Mr. McGregor's focus, his ability to focus. It's very similar to, in our discussion here, what Tim mentioned about that if you look at your own business, for example, your business owner reinvesting in your own business because perhaps the returns are greater than what you can achieve outside of your business, or even if they're comparable or even less than what you can achieve outside of the business, then it still might make sense to still reinvest in your business because it's what you know and understand. That's something that's very key, that
be considered risk-adjusted returns.
Risk-adjusted returns. There you go. It's about focusing and understanding what your strengths and weaknesses are. It's actually more important to understand what your weaknesses are than to understand what your strengths are. You could see that with this series about Conor, because of his intense focus on the training regimen, what it took to actually get into that mind space. You wonder why there's so many months in between these bouts. There's a reason for it. There's a process for it. And he and his team understand that to a T. If you find something that you know and understand like that you can focus on, that you have the ambition to achieve on that, it's the same mindset that we apply to any investment. Our threshold for saying yes to investments is very, very high. There are far more investments that pass through our filters of figuring out what we will and will not invest in. There are far more that fail those filters than ones that get through. And that's because it's not because we have a plethora of opportunities in front of us. It's because our bar is so high. There's a reason for that. Because why would you invest in your so-called top 20 ideas when you can invest in your top one idea that's going to give you the biggest bang for your buck over the long term? It's the same concept for any one of these investments that we may consider with any of the 4 topics that we just discussed. It has to have the right acumen for us to want to invest in it. It's not a case of whether it's a black and white yes or no. Does it go through our investment filters, and does it pass the test with a reasonable margin of safety? That's what's important. Any investment that comes across your desk.
Is it okay if I add on a little bit to what you just
Please.
said? The Conor McGregor example, I have not seen that series. I have to watch it. but I think that I would challenge the audience to go and find anybody. I don't care if it's a writer, if it's an actor, but somebody that you would consider or deem successful, even if it's someone in your own personal life, and then start asking that question of focus. And what you'll probably start to see is that a lot of those successful people, success can be defined in a lot of different ways, have focused on very specific things, right? Athletes are a really easy one. I could think of right off the top of my head, you have Kobe Bryant, you have LeBron James. You want to go business, you're looking at Warren Buffett, Charlie Munger, Bill Gates, Elon Musk.
Dr. Dre.
Dr. Dre also very relentlessly focused on a very certain thing, and they've maximized that. And they do not get distracted by outside forces. And I would argue very significantly, again, if you deem success in family life, and you go and ask somebody you have deemed that, they've probably put very strict priorities on where they spend their time, how they spend it, and who they spend it with. Right? Though that relentless focus does benefit in a lot of different ways. So I really appreciate you bringing that up, because I think that's a really good point.
All right.
That's all I got. Thank you everybody so much for listening to Nathaniel and I talk about 4 trendy industries that we will and will not invest in. We hope everyone has a wonderful rest of their day or night, and we will talk to you soon.
Like and subscribe.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.